but that's still 10 grand. And in a minute, I'm going to show you why you really, really want to do this. And some of y'all in tax season right now and are just handing it over to your CPA or to your accountant. Look, they're not going to do these numbers for you. They don't even return your phone calls during tax season. Sales tax deduction. There's a bunch of cool deductions that we really don't talk about because it requires a lot of receipts and a lot of proof that are on the itemized side. And if you don't know, there's a standard deduction that everybody gets here in 2025 it's a cool $15,000 per person. So, if for keeping the flesh alive, for keeping yourself alive, the IRS goes, well, okay, we'll give you $15,000 off. Nice. If you're married filing jointly, that's two of y'all, it's 30. No big deal. Easy math. But if you thought, that standard deduction is awfully kind, thanks so much for our voluntary tax, but I think I have more deductions than that. And this is not business. This is just you, the social slave, as we like to say. Then you can itemize. And there's a bunch of things on that Schedule A that has itemized items from the Department of the Redundancy Department that has things that could potentially exceed $15,000. And one of those is the sales tax deduction. Now, you cannot do more than $10,000 in sales tax deduction. And a little bit bad news, it's combined with some other deductions like local taxes, like your property tax, or if you have other state or county taxes, all of those combined with your sales tax cannot be more than $10,000. But that's still 10 grand. And in a minute, I'm going to show you why you really, really want to do this. And some of y'all in tax season right now and are just handing it over to your CPA or to your accountant. Look, they're not going to do these numbers for you. They don't even return your phone calls during tax season. If you have tried to call your CPA during tax season and they don't return your phone calls, put a 7 in the chat, just so I know who my mates are in this, right? They don't return your call. So for us, we need to do the work. What's the work? Just do a little math. It doesn't take much. So we put the sales tax deduction in and we go, okay, well, maybe I do have $20,000 in sales tax. That'd be a lot. You'd have had to have, in my state, I see it. I see you, B Money. I see you, Read Form. I see you, Sherry. Yeah. Bad news. Sorry. So we've got, let's say, $20,000 in sales tax. You can't take more than 10. And then if you say, I got $1,100 a year in property tax, well, then you can only take $8,900 of the property tax. All of them together can't equal more than 10. And if you say, well, yeah, but the standard deduction is better. Voicemail is not even set up. There we go. Yeah, even my favorite kinds of accountants. Yes. So, if I have to have a $15,000 standard deduction, how does $10,000 help? Well, because that's not your only itemized deduction. Let's talk about the interest on your mortgage. Now, this one you've probably heard about. Your CPA's probably told you about it because it doesn't require very much burden of proof. All you need is the 1099 from the bank going, you've paid this amount of interest, and that goes and is reported to the IRS. That's easy. The rules on taking the interest on your home is that the loan amount cannot be more than $750,000. So that the loan's $1 million, that's okay. You can only deduct 3/4 of it. 750 is your cap, at least this year. So if it's below that, like some of you have, then all of the interest on the mortgage on your home, deductible. Now I know on my house, my last house where I had it was about a $400,000 mortgage. The interest I was paying in those first 2-3 years, it's always pushed it to the front, the max on the amortization. Yeah, I was doing, I don't know, $25,000 a year. You think about that. So actually it wasn't 25. It was like I had a really great loan. It was probably 15,000. Okay, 15,000 a year. Now, if I were single, that would be enough to have me go, I got the interest rate on my house, and I got $10,000 in sales tax. I'm at $25,000 in itemized deductions, y'all. I'm way above the $15,000 standard deduction. Way above. Let's do that. And you can, but it gets better. Because then you also, for all y'all playing the lottery, or y'all going to whatever place you're gambling, your gambling losses are also deductible. Now, Sterling, do you remember the rules for gambling losses?
I
There's
What
only
I
really
remember
one
is
rule.
I save all my tickets now because, I'm destined to win. It's just a matter of time.
Yes.
So yes. So I think I
Yes.
can take up to the amount that I win. So if I don't have to save the ticket if it was $2, if I spent $2, right? So but yeah, I think that's the rule.
You got it. You can't deduct more than you win. So if you lost $10,000 playing the lottery and you won 2,000, you can only deduct 2,000. But if I did, now I'm at 17,000 overall.
So what do you do, Mark, when you go play the slots and you put, your 75 cents of quarters in? How do you keep up with that information?
That's a very difficult thing to do. It's why I don't suggest you play the we call them the one-armed bandits, because it's very difficult for you to justify. Now, what you can do is go to the cashier, and then you go to the cashier and put your money in, and you get chips, and you say, I want, or whatever that thing they put on the card is, I'd like a receipt for what I put in. And then you say, and then I want a receipt for what I was able to cash out or what I couldn't. They'll give you receipts. But there's some limits there. It's very difficult. It's not really the most effective tax way to gamble, because it's difficult to prove. So then you have, on top of that, charitable donations. Now, on the charitable donation, you can put in, don't go crazy. You can't spend all of your money and give it to your church. You can't be like John the Baptist and just give everything away and eat locusts and live in sackcloth in the desert. Some of your money, there's limits. But if you tithed 10% and had $100,000, that's another $10,000 that you get to deduct off your itemized deductions. And let me be clear about this too. A lot of people are like, oh, I give money to my church or the American Red Cross or whatever that is, and I get a write-off. No, you don't. Not right away. Because if you're married filing jointly, what's your standard deduction? Not $15,000, $30,000, both y'all put together. And if you donate to your church $25,000, and that's all you know to take, and that's all your CPA did the calculations because they're not going to do the math for you, that's not enough to take the itemized deductions. Your standard deduction, actually more. So you lost that deduction, technically speaking. So unless you're willing to donate more than, if you're married filing jointly, $30,000, and you don't know to take the sales tax deduction, the local tax deduction, the interest on your home deduction, you're going to lose some of those deductions. Y'all got to donate some more or something. I don't know.
So what happens when I go and donate, random household goods to the local Salvation Army or the Goodwill? Like, is there a dollar amount that I need to get the receipt, or do I always need to get the receipt?
Well, I mean, it's always good to get the receipt, but they're not required to give you a receipt over cash stuff over $250. And if it's over $5,000, then you actually have to get a third-party assessor to find out what that value really is, and then they have to give you a receipt. But if it's over $250, that's when the receipts need to show up. But beneath that, not really, no.
Oh, that's good to know, especially if people donate like cars, because now that's a big new thing that happens now, is that you can salvage old cars that you don't necessarily need anymore for charities.
And while we're here, let's see. Rondi says, instead of donating to my church personally, can I donate via my LLC and take the deduction? Of course, the rules are the same and when we say LLC, there's a bunch of different versions of LLCs. So it's either an S corp, or it's a sole proprietor if it's a single member, or it's multi-member, it's a partnership. Any of those, long and short of it, pass the charitable nature of that down to its members. So if you're in a multi-member LLC partnership, let's say there's 3 of you, and you have $1,000 worth of stuff that you're going to donate to your church, and you do it through your LLC, that means that you've done a capital contribution into the LLC, giving you basis. Okay. Now the LLC donates to the church. And when tax time comes, then your donation comes to you, but now pro rata to your shareholdership in the LLC, in the partnership, which means that instead of getting the $1,000 that you would have gotten in deductions, itemized deductions from charitable, that you had done personally, now it's split up between the members, and you only got a $333 deduction because the other two Bahanyaks got the other thirds. So yes, absolutely. The only place, well, I shouldn't say only, but for the most part, the only place where those charitable donations do not just pass through to you in the C corporation because nothing passes through to the shareholders. And the C corp gets some really cool benefits out of doing that as well. It can donate, it can write off every dollar, every penny it donates to charity up to 10% of its income. It doesn't have any limits like we have with standard deductions. And then let's see, root form says, so if it's over during the year versus at one. So if it's over during the year, I'm not sure what that means. Help me understand what that means.
If she donates, let's say she donates $10,000 to her church versus donating $100 a week. Is there any difference?
Oh, I see. Yeah. So that's a great question. So what if that the limit's $250 and to get a receipt and you just donate $10 for 12 months, or let's say $100 in 12 months. Now it's $1,200. If I never got a receipt, am I still good? And the answer is yes, because it was over a bunch of time. And hey, if you drove to the church to donate, that's also donation miles, charitable mileage. It's not a very good mileage rate, but you can definitely take it. And I have never, ever seen anyone audited because they took charitable mileage. Now, charitable mileage, I mean, unless you're driving to like do relief in South Africa, Johannesburg or something, it's going to be very, very small. And the mistake that people make is they go, well, I go to church, and every time I go to church, I take the I take the mileage deduction. No. You only get to deduct the mileage when you put something in the offering plate. Then you're like, well, wait a minute. You mean all those times I go to church and I have to suffer through the hour-long speech? I can't donate those miles? Not unless you put something in the plate or handed a check or whatever. So what you do is, if you're really miserly, if you're Dutch, I'm a quarter Dutch, so I get to make fun of us. If you're Dutch like me, if you're not Dutch, you ain't much. So you're going to go into the gutter, you're going to find a penny. And you're going, my penny now, possessory lien, I got a penny. I go to the church and I drop it in. Deductible. Mileage.
Well, this is good news. Because we just started Lent, the season of Lent yesterday.
That's right. What are you giving up? You know what I'm giving up?
What are you giving up?
As of yesterday, what am I giving up?
Gossiping.
Mm-hmm. 30-day gossip fast. We just did a 30-day complaint fast, which was quite difficult indeed.
Yes. You will notice that you complain all day long, whether it is out loud or in your own head. That was the most shocking thing, was how much I complained in my own head that isn't actually out loud. So,
dude, it's so insidious.
Yeah. But the great thing about giving it up is there was nothing else to do besides take action. You get more done in 30 days. Because there's nothing else to do. You just had to go do something. You couldn't complain. So it had leftover energy. So you had to work it out and figure out something to do about it. So
yeah. And she couldn't complain to me because I'm like, I can't.
I don't know how this gossip thing is going to work. This is going to be very fun. I'm excited about this.
It's going to be good. Yeah. I've done it in the past. It's really quite difficult. It's easier to spot than complaining, but it's harder to stop doing, because you're like, oh my God, have you seen Johnson? He's got a limp. What happened to him? Oh my God, it looks so stupid. No, it's gossip.
Especially when you live in a community of human beings who all know each other and love each other and are excited about things, it's very easy to gossip about all sorts of stuff. Happy news, bad news, sad news, crazy news. It's going to be very fun to see what we get to talk about for the next 30 days.
I live in a small town. It's not the paper mill that runs this town. It's gossip.
That's true.
It's gossip. All right. One other thing about the itemized deduction before we get really derailed here. So we talked about charitable, obviously. We talked about the SALT deductions, which are sales tax, local taxes, et cetera. We talked about the interest on your home deduction. We talked about gambling. But the one thing we haven't talked about is medical. And we're going to cover HSAs at the end, which we do really want to hear, because I learned something in the last 3 months that I didn't know about HSAs, which are completely changed how I use them. Medical, you can take your medical expenses as long as the medical expense is greater than 7.5% of your adjusted gross income. So if toward the end of your 1040 there, where it says this is your AGI, if that number, I'm making it up, let's say it's $100,000, and you have $10,000 in medical expenses, that's 7.5% would be $7,500. So you'd have $2,500 that you could deduct. Again, you had $100,000 in overall AGI. you had $10,000 in medical expenses. The threshold was $7,500, the 7.5%. And so this amount, the $2,500 is deductible. Now it can go on and up to $50,000 if you want. All of that's deductible. Some people are, have heart attacks, and some people have, the insurance didn't pay or whatever, or you just got, even chiropractic bills. If you can justify the medical expense as medical and truly necessary, that's great. So one of the people in my enrolled agent training, her mom, let's see if I get this right. It doesn't really matter, but somebody put in a wheelchair ramp and wheelchair bars on their house, which was super cool. And that they made as a medical expense, which was because her mom had to be in a wheelchair. And so they were able to write that off that year. But the problem is they couldn't deduct it in any other way, because what they actually did was improve the value of the house, which is a capital expenditure for the house, which is supposed to go against basis. So they ran into a bunch of problem with that. So be careful if you're like, some people put an elevator in their house, $300,000, $400,000, $500,000 elevator to help with the thing. Cause they've got Sterling's worked on some pretty large houses in Hollywood, and there's an elevator in there. Well, can you write that off if it's for medical? Well, I would definitely consult with somebody, because the issues to your house are also strong and need to be considered. But if you could,
Mark, does it matter if the person is more of a practitioner of Western medicine versus Eastern? So, for instance, like if I go to my doctor versus I go to my acupuncturist, because here in LA we all have an acupuncturist. So, as long as it is generally considered a medical need, is there any other criteria that the IRS has any commentary about?
I mean, if it's medically necessary, it's medically necessary. And if one of our favorite sayings that we talk to our members about is, if you can defend it, you can keep it. And that's one of those gray areas. And fortunately, it's gray. There's a lot of gray areas. We haven't talked much about business deductions yet, but there's a lot of gray areas where the IRS is like, if it's reasonable, ordinary, you can keep it. But be able to prove that. This week, all week, we've had a big discussion in the membership about, how come we can't write off first class flights? How come we can only write off economy flights? We can't write off first class flights. And how do we do that? What are ways that we could legitimately, not trying to avoid, not tax evasion, not trying to commit fraud, but what are defendable ways in which we could actually write off upgrades to flights or vacations, so-called vacations for business purposes? What does that look like? And that's a very, we should do a podcast just on that. Yeah, because that's a very interesting subject. So we're belaboring this sales tax deduction, but I want to give you if we added $10,000 sales tax, we added $2,000 for gambling debts, we added what did I say it was, $10,000 or $15,000 for interest on your loan for the year. What are we at now? $27,000, and then we added another $2,500 for the medical, and then you did, I'm making it up, $10,000 in charitable donations. You're now at $37,000+ in deductions. And even if you're married filing jointly, your standard deduction's 30. Now you're at 37. And if you're in let's say you're even in a 20% tax bracket, which is pretty hard to do if you're doing those kinds of deductions. Let's say you're in a 30% tax bracket. You just saved yourself $2,100. There's never a point in all y'all's life where $2,100 means nothing to you.